And we're back. Welcome, options traders. Happy Wednesday to everyone. And occasionally I get emails from people asking if I have a set of trading rules. And they'll say, well, here are mine. Can you please tell me if these look like they're good ideas? And they'll go on to give me a list of things like, well, I exit if I'm down 20% or 50%, or if I can make a 50% gain or a 100% gain, then I exit. What do you think about these rules? Are these a good idea? Well, regardless of the numbers that you're using, these are arbitrary goals. And so the short answer is no, they're not good ideas. They absolutely go against the very idea of trading. You have to realize that what you're doing when you are trading or even investing for longer periods of time, you are always measuring your current position at the current prices, not what you paid for it, but at the current prices, and we have to stack those up against the new information. Where do we think it's going? Looking at technical indicators, information, news, things like that. That's how you move day to day. You don't just set an arbitrary boundary and say I'm either in or out. So that's the short answer, but let's go find out more why these arbitrary goals are a really bad idea. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So this whole idea of trading decisions, let's start with a little question. Let's say that you pay $3 for maybe a call option and you're thinking it might be worth $6. Is that a trade you would take? I know there's a lot of assumptions in here, but just kind of work along with me. This is one scenario. Now there's another scenario where you could pay $6, but there's also a very high chance that it might be worth 100. And the question is, would you take that one? Or which of these two would you prefer? So think about that for a moment. We'll come back to revisit this in a moment, and you'll see why it makes sense. But the first thing is with goal setting. Yes, it is true that setting goals helps with decisions. And we all know that they have to be specific and measurable and realistic and all of these other things that people talk about. But again, to give yourself arbitrary boundaries like exit at a double or exit if I'm down 50% or whatever, is really giving yourself an arbitrary boundary. You're not measuring it against new information. And remember, trading requires you to make decisions based on current information. So the whole idea with trading is that probabilities are only good for a given amount of information. So for those of you who have had statistics, have certainly heard of Bayes' theorem. I'm not even going to call it that because I think it's easy to get the point across. But that's the whole idea of Bayes' theorem, is to say, let's take new information and update our outlooks. And that's really how you have to approach trading. So for example, let's say that we take a single die, you're going to roll it, and I say, what's the probability that you roll a 5? And you say, well, there's 6 sides to this die, each one's equally likely, and so there's a 1 in 6 chance that I'm going to roll a 5, or about 16% of the time we should see a 5. And that's true. But now let's say that I roll the die, you don't see it, and I tell you that the number is at least a 4. That's new information. Would you say that your probability is still 1 out of 6? See, if you know that it's at least 4, you know that the answer has to be either 4, 5, or 6. You've knocked 1, 2, and 3 out of the list. So now the new list of probabilities is 4, 5, or 6. So we would say that there's now a 1 in 3 chance of rolling a 5. So even though it's the same die and it's the same number 5, the probabilities have been greatly altered, in this case exactly doubled, just on one new piece of information. I give you this fact that it's at least a 4, and now it alters your probabilities. And that's really the whole idea of, again, what's called Bayes' theorem. That's not really important for right now, but it's just to show that's the whole idea, that we have to update our outlooks based on new information. And that's really what trading is about. Every single day, we get a new price. Now, it doesn't matter that that's the price that you paid. That's what it's worth right now. And remember, we could mathematically say that's the same thing as if you had paid that price, because you could choose to sell it right now. So if you're choosing to hold on at this new current price, that is exactly the same thing as paying that price. And we have to say, given this price, do I have new information that gives me a new decision or new probabilities? So, with that little bit of a background, now it might be easier to see why arbitrary boundaries are a bad idea. Think about it like going to a casino and playing blackjack. Why would you set a goal to say, well, I'm going to stop if I get 18? Well, what if you're dealt 17? Are you going to hit because you haven't gotten to 18 yet? Well, that would be a really bad idea. You just wouldn't have an arbitrary goal like that. Alternatively, should your goal be to always bet the same amount? Well, what if you're holding 21? Now, in a casino, I know you have to place your bets beforehand, but the point is, in trading, you don't. We get to say, should I stay or should I go? Should I continue to hold? Should I hedge, roll, morph it somehow? But people don't when they have an arbitrary exit point or an entry point. So think about it like this. If you have an arbitrary exit point, let's say if it gets to 100%. So let's say an options price is down here and you're approaching this. Well, should you exit it just because you're about to cross this line or just because you did? Who's to say that it's not going to continue on this side of it? Why would you exit here if new information is saying this is a really good hand to hold? Or maybe let's do an overroll or a morph somehow so we can stay in it. All of those possibilities are wiped off the table if you're going to exit just because you cross this imaginary line in the sand. On the other hand, what if you say, okay, well, what if we put a floor and say I'm going to get out when it falls at, say, 50%? And of course, we'll get out if it goes up 100%. Well, all right, maybe just because the option is down here and about to hit minus 50%, does that mean that it's going to? Or even if you're down 55%, is it not possible that it could come back up this way? See, just because it's down at this level doesn't mean it's going to stay at this level. We have to evaluate the new position. We have to say, does it warrant holding or continuing to hold under the new information? Remember, every single day you have new information that you didn't have yesterday. So let's go back to the question that I posed earlier. You can pay 3, you've got a position that you think might be worth 6. That's one choice. But you have another one where you can pay 6 and it might be worth 100. Now, when I posed the question this way, there's a very good chance you thought, well, gee, if I can pay 6 and I might be able to get 100, I would much rather have this. But notice that 6 is exactly double 3. So what if you actually started over here on the left by paying 3 and it has moved to 6? Isn't that the same thing as saying that you've paid 6 and it now might be worth 100? So see, when I pose these as two separate questions, my goal was to expect most people would say this is the better deal. But if you have an arbitrary boundary point, you would have been out back here. So just because you paid 3 and it's now worth 6 doesn't mean that you necessarily exit. It might be a new position that you have effectively paid 6. And if you're saying under the new information, maybe there's a huge chance that there's going to be a buyout or there's some type of a meme stock and it's just running like the wind. We might be far better off holding under the new information, even though the option has already doubled. So remember, when it comes to your options decisions, exit a position when new information alters your outlook. If the new information says, this isn't really what I signed up for, or I think it's really fizzled out, things have changed to where I'm no longer comfortable holding this, well then by all means exit it. But that doesn't mean that you should have exited just because of an arbitrary point. In other words, you should look to maybe hedge risk as positions move in your favor. Try to stay into it as long as you can. Just because an option's doubled doesn't mean it can't double again. And this is why it's so important to understand your hedges, rolls, and morphs. So for example, maybe I buy a $100 call. Here's our bend at 100. We pay maybe $20 for it. Maybe it's a longer dated option or in the money option. And as the stock is moving in our favor, I roll it. So now maybe I roll it up here to the blue, and then it moves more in my favor. I roll it up to now the 110 strike. Now I've gotten myself into a guaranteed gain. I've gotten all of my initial premium back plus a return. That's locked in, but I still have unlimited gains. Well, why should I stop here and say, well, you can't go broke taking a profit. Let me exit it and move on to something else? What makes you think that something else is going to be better than the thing that you're in? What you need to do is to say, based on the current information, what can I do now to stay in it? Maybe alter the risk-reward relationship. So for instance, maybe I could leg into a vertical spread, but a partial one. If I'm long 10 contracts, maybe I could sell 5 contracts of the 115 strike. And now I've got the potential to see it rise from 110 to 115, capture that gain. And then I've also got unlimited gains beyond there, but notice that my deltas are reduced. If I had 10 contracts, I've got 1,000 shares equivalent here. Now it's only 500. Well, it's better than zero. And I have shifted the green line up a little bit higher from this credit from the sale of these calls. Maybe the new information is telling me that there's a huge skew and that this is a much better option to sell. It didn't look like that yesterday or a couple of weeks ago, but it does today. Well, let's take advantage of that. Let's capitalize on it. Maybe it looks like the stock might be topping out or bumping into resistance. Maybe I could leg into a back spread and do this. I could now alter the risk graph to where I can make money if it falls. I can still make an unlimited amount if it rises, just not as much. Notice that the gray line isn't as steep as the red line, but there was a trade-off. And the trade-off is that now I have the ability to greatly profit to the downside. So again, this is why things like your hedges, rolls, morphs, your strategies are far more important and far more helpful than just picking an arbitrary line in the sand. So for people who tell you that you should have these arbitrary boundaries for whether it's an entry or exit points are really not understanding options. It's a simple crutch for people who don't understand strategies, hedges, rolls, and morphs, because the real art comes from staying in the position. Why? Because trends, whether up or down, always last longer than people expect. Start basing your decisions to continue holding or to exit based on current information and on potential hedges, rolls, and morphs, not on an arbitrary line in the sand. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.